Thanks so much for tuning into the earnings conversation with the management of Mphasis. The numbers, obviously the revenue being down 4% points to what is relatively relative to estimates look like a weak quarter, though not too much. But estimates were 3514 crores. They've come in at 3361. What is heartening is that in these tough times they've pulled out or pulled up the EBIT performance quite admirably relative to estimates, and which has helped them on the bottom line performance. But the question marks obviously will be around how predictable or how easy is it to kind of look at the landscape and think of what revenues could look like, especially in light of the fact that BFS in the US might be under a bit of a cloud. So Nitin, Rakesh, and Manish Dugar joining to talk about that. Gentlemen, both of you, thanks for joining in. Nitin, at the outset, it's not been easy. The last 2 quarters stand testimony to that. I would love to understand from you qualitatively first, how difficult is the environment there?
Thanks, Neeraj. Thank you for having us. And I think you summarized it well. The last couple of quarters, starting, I would say, middle of 2022 calendar year, as the negative surprises on the interest rate movement kind of got baked in, there were definitely certain pockets of weakness that got exacerbated, especially in the last 2 quarters. And I think the top of the list there is the mortgage business. We talked about that quite extensively in the last earnings call as well. I think it's a perfect storm that continues to play out. Not only are the origination volumes, at a record low, probably, given that the 30 years at a 40-year high in terms of the mortgage rate. Obviously, that means that refinance is out of the question. So that's the other second hit. Home equity, which was kind of a little hedge to the origination side, given the strength in housing prices, started to tail off early in Q4 as well. And I think there was a record decline in the US home prices, in Q4. So I think there's definitely a very headwind environment in that business. Capital markets continue to be shut, so there's definitely a fairly strong focus on cost containment by a lot of the large banks that have exposure to Wall Street. Main Street banks continue to actually do fairly well, given the strength of the consumer. Asset and wealth continues to be fairly stable as well. So I think it's a little bit of a nuanced, view to the environment. Of course, the March regional bank issue was a little bit of a left field for, I would say, everybody, the regulators included. That did create a sudden, pause and reprioritization, not only by the regional banks, but also, by the entire segment, so to speak. Some of that's kind of stabilized, but there are still question marks lingering on whether the next domino will fall, whether it comes out of the banking sector, or it could be other treasury holders that will actually have to take a hit on the mark-to-market side. So I think the environment continues to be uncertain at best. With that backdrop, if I then look at our deal flow, very heartened that we actually had a 150 million plus deal this quarter from a banking customer. We had 2 large deals overall. So I think from that perspective, deal making is still happening. Transformation programs aren't going away, because you suddenly can't take a U-turn and say, I'm not going to exit the data center this year or next year. You can't take a U-turn and say, I really don't need, to have an AI strategy. So I think strategic investment programs will have continued. The pace of decision-making definitely got slowed down, and the pace of conversion from sold deals to revenue has also been a little bit challenging because of this sudden reprioritization based on, the business as usual taking over versus, programs taking over. So I think, just to give you some metrics, on a YOY basis, our pipeline at the end of Q4 is up 36%. Within that, the non-BFSI pipeline is up 52%. So, good news is that our healthcare, travel, and even high-tech business continue to actually perform well. Even on a sequential basis, the pipeline is up 9%. The win rates have actually stayed stable. So we've continued to gain wallet share as well as, win new customers. What that tells me is that as we, get through this immediate short-term phase and conversion kind of ramps back to a little bit more normal, we should set ourselves up for larger TCP conversions, because expanded pipeline will actually come into play there. So I think a lot of activity in the pipeline is probably the brightest spot. Some signs of stabilization even in our mortgage business. I think Q1 is probably a stability quarter there. Bulk of the decline is behind us. Our assumption is we are not too far from seeing a bottom in that, at least in our business, because we are now at a point where that much volume has to be sustained, for our customers, and they've indicated the same to us. Green shoots have appeared even in the mortgage business, because we've seen sudden activity of deal making, at least on two fronts. A lot of clients are taking the opportunity of lower volumes to say, I need to refresh my tech stack on the mortgage side. I want to introduce a new product line as the market recovers. So that's one in a level of activity. And they're also very open to cost takeout ideas, which means more for us to take over. So I think we've not only seen pipeline buildup, we've also seen deals starting to close in the mortgage business, which wasn't the case 3 months ago. So still too early to call victory, but I think we are not too far from being in the zip code of having seen the worst behind us in that business. And I think as the short-term fears that have been lingering over the banking crisis kind of start, stabilizing a little bit, we do believe that, through the remainder of FY24, we'll probably see signs of growth and stability. Our visibility right now in the direct X mortgage business is that we should at least be able to get to at market growth and potentially look at higher numbers as we see some volumes recovering and some deal making coming back.
Nitin, our client it's a tough time out there, which is why I'm trying to understand the qualitative aspect. Our client conversations, which might be talking about pausing some of the non-critical piece, indicative of any timelines about when some or a major part of that spending could also start? Because I mean, I look at, you mentioned sequentially there was a 9% growth. I saw Q3 as well, there was about in the TCV about a 19% sequential growth, but 60% was BFS for you back then as well. I don't know the nature of the deal wins in Q4. So I'm trying to understand how our client conversation shaping up for, let's say, the immediate future, Q1 and Q2. Are they indicative of some pickup there, or is it postponed to the second half?
Yeah, so I think again, Neeraj, if you look at it, right, I don't think across the sector the client conversations have stopped. I think they've stopped more where either there are issues or they're very, or they're Wall Street type banks. And Main Street banks are still continuing to focus on, doing what they had to do. Okay. They took a bit of a breather and a pause, in March. But I think the fact that our largest deal this quarter, over 150 million, is a BFS deal, tells you that there is deal making happening in banking as well. Right. So I think the way I would characterize the deal making is it's slowed down, but it's not paused. There is absolutely opportunity to continue to do deals, especially deals that combine cost takeout and transformation together. And that's why we were able to supersize this deal win as well. I think as I mentioned, my belief is, given that the expansion in pipeline is indicative of the ability to create new opportunities in a very proactive manner, and the fact that our win rates are actually very stable, means that we're actually setting ourselves up for larger deal wins as we go forward.
Okay. Manish, just before I come to you, one more follow-up to Nitin on this, because since we are on the topic now, Nitin, the point is the last 3-4 years, maybe longer, whatever, but the last 3 years, at least to my memory, in cricket parlance, you guys are known to come out on the front foot and hit those drives, right? Is it time to bat on the back foot, part one, because of the environment? And therefore, the last couple of quarters, and particularly 4% revenue decline, is a stark contrast to what you've done all these quarters as well. I'm not asking as a necessity as to it should come back, but is there any indication of when does meaningful growth start returning, or is the environment too fluid right now to make such a call?
So, Neeraj, I think the stance really hasn't changed. Of course, even in cricket parlance, sometimes you go on the back foot to hit a 4. Right. So we are definitely, looking to continue to hit boundaries and sixes. And that's what I qualify as large deal wins. We are also making sure that, we keep rotating the strike and making sure that, our wallet share keeps going up as we look at opportunities to cost, for cost takeout or vendor consolidation. Also, a lot of transformation deals bring pull-through revenue, that gives us wallet share as well. So the fact that we prepared ourselves for a headwinded environment, and started to focus on operational metrics is testimony to the fact that we were actually able to show resilience in the overall business, despite the fact that some of the issues that we had to deal with over the last 2 quarters were, kind of unprecedented and in some cases unexpected as well. For example, the March issue. So I think the stance hasn't changed. We are still growth oriented. We are still forward leaning. We are still very focused on deal making. And we still, as I tell my team, we have to find a way to grow the hell out of this recession. So I think that's the way we are thinking about it.
Okay. I'll come back, Nitin. Manish, the standout part has been that in such an environment, what you've done on the operational metrics. So clearly there is an expansion. It's much higher than what was estimated as well. What clicked this time around?
As you know, fresher deployment is something that we have been working on for a while, and we are at a record high fresher percentage in our execution. Couple that with, like they say, never go let go a recession base. So we really pulled up on the utilization. Unfortunately, as the revenue drops, it creates some inefficiencies, which is why all of the benefit of utilization improvement and fresher deployment is not visible in the gross margin. It expanded, but it expanded only to 27.4%. And combine that with the fact that absolute costs for S&M and G&A, can't change on a quarter basis. And as the revenue drops, the percentage goes up. So because of those, EBIT remained flattish. We would have liked it to go up a little bit. If you look at our guidance for the year, we are talking about 15.25 to 16.25. I think what's not visible in the guidance is the confidence that we expect the reported margins to expand from 15.3 upwards, versus it remaining almost flat for all the 4 quarters of last year.
So would it be higher compensation, maybe factors like utilization rates coming lower or something? I mean, you are at 17.11, if I'm not wrong, for Q4. So the band that you're talking about being lower than where you are right now, or the exit number that you have, even if the annualized number would have been lower per se. So do some compensation related headwinds or some other travel related factors, not headwinds, but factors come to kind of make you go to that band that you're talking about, Manish? It is what you guided for, but I'm just asking.
From if I understand your question right, what is driving the upper end of the margin to be brought down to 16.25, and do we see any concerns in delivering to the expansion?
Yes.
If you look at the travel expenses, the model is kind of stabilizing in terms of work from home, hybrid, how much to travel. And we have seen travel expenses increase, but it has not increased to the levels it was before the pandemic. And we don't expect it to increase substantially from where we already are.
Okay.
So far as compensation is concerned, we talked about it earlier as well. We have a process of, a regular cycle. So compensation are kind of reset to as of like last quarter end. So, and as you know, the pressure on compensation has come off, from what it was maybe 4 quarters back. If at all there is a conversation of, our peer groups looking at letting go people, in general, there has been a reduction in headcount across the board, right? So we don't see anything as a headwind, as Nitin mentions always. The only risk to revenue is margin is the revenue. So, we need to focus completely on getting ourselves back on track. Hopefully from Q2 onwards, we'll see decent sequential growth as well. And when that happens, we should be able to report an expansion in the profitability.
Right. Well, but still, admirable job, Manish, and kudos on that front to you and team, of course, specifically out of the whole piece out there. Nitin, before we wrap up, I'm guessing you guys have a call to attend as well. Just trying to understand. I mean, as a company where growth is DNA, these must be uncomfortable times. As you told me that you were telling your teams that you're going to make out of this smelling like roses, so to say. Does it happen in a predictable fashion? You would have seen such cycles before, both on the asset management side and the tech side. Does it happen in a predictable fashion, or is it take each quarter as it comes? And therefore, maybe for Q1, don't expect too much. Let's see how we wait through that and then look at Q2 or Q3. How does it work out?
So I think, Neeraj, there are things we can control and the things we can't control, right? We cannot control the macro, but we can definitely control the micro. As I also mentioned in the last quarter, I think that's really the theme for FY24 for us, which is control what you can, be very forward-leaning in staying close to customer, don't lose wallet share. In fact, gain wallet share, protect your core business and gain wallet share. There will still be things that will happen outside of your control. Like we can't do anything about a bank that becomes insolvent, for example. Right? Those things we cannot control. But I think the stance continues to be, as I mentioned, growth orientation. We have 1 or 2 pockets that really were headwinded. We think we are actually at the bottom of that. Even in the DXC business, and we didn't talk about it, we actually have visibility into a stability over the next 2 or 3 years based on where we stand with that partnership. So I think a lot of the headwinds, at least the 2 big headwinded segments seemed like stability in Q1. Outside of that, I think the direct business still grew 19% in FY23, probably, I would say, the upper end of the growth compared to peers. Now, of course, that doesn't mean that it translated into top-line growth for the overall consolidated numbers. But I think we can control that, and we are really focused on making sure that pipeline to TCV and TCV to revenue doesn't go, get away from us, even on a Q1 basis. So yes, play it quarter by quarter, but it's a marathon that is a quarterly sprint, and we are not getting away from that.
Yeah, no, so sorry, people may not realize we're talking this way early in the day, so I haven't had a chance to read the entire release. But Nitin, just wondering, at the start of the year, are you formally or informally guiding towards how the year could be YOY?
Yeah, I think we are guiding towards three things. Firstly, we are guiding that bulk of the decline in the mortgage business seems to be behind us. Right? Okay. We have to wait and watch for quarter one to see whether we are, what percentage of the decline is through, but I think bulk of it is through. We are at the fag end of that, given just the nature of the pipeline, the nature of the volumes, and we've kind of cut to the bone in terms of what our clients need. Two, we are also guiding that we see stability in DXC revenue going forward, purely based on the status of that relationship and our multiple efforts over the last 12, 18 months in stabilizing it. Three, on the direct non-mortgage business, we are guiding that we should be able to at least grow at industry. And you can derive the industry growth based on the peer group guidances that have come out primarily from the India ID pack. If you put all of that together, you will actually see that there is not just an assumption but visibility to significant sequential growth Q2 onwards, purely based on the back of what we're seeing in the business today.
Sounds good. Maybe at the end of quarter one, when we talk again, gentlemen, there will be a lot more reasons to talk about even better growth than what we're talking about right now. All the best for the next quarter and more. And thank you so much for speaking to us today.
Thank you, Neeraj. I have my cricket pads on.
Sorry. Yeah, of course. I kind of expected before the interview started. Gentlemen, thank you. Thank you for talking to us.
Thank you, Neeraj.
Nice to tune in.